Welcome back, everyone, to the SEC's Small Business Capital Formation Advisory Committee meeting. Here on July 22nd, we are back, and we are going to spend the afternoon having a discussion about some of the amazing speakers that we heard earlier today. We were very fortunate to have such a breadth of knowledge come and talk to us about all of the things that were said in the 2020 proposal that did not go through to the commissioners, and then also 3 speakers who are working out in the field with everyone. So let's just maybe start off, a couple people I'd love to hear from. How are you seeing finders out in the world right now? I know, like George, for example, you're the crowdfunding space. Do you see it? Bart, I know you see it a lot, so maybe just start with that.
Yeah, happy to jump in. I don't see it a lot within crowdfunding. As an entrepreneur myself, I see it all the time. I get approached a lot by finders, and I don't know how reputable they are. And that credibility gap and the fact that it is such a gray area kind of deters me from working with them. I guess my perspective as a founder is, like, I'm pretty good at small business lending. That's what we do. I am not great at fundraising. Right? Fundraising is a job in and of itself. When I think about my company, I hire someone to do our taxes because you don't want me doing our taxes. I hire someone to do graphic design because, trust me, you don't want me doing graphic design. Fundraising is a full-time job. It is hard. It is, incredibly intensive. And so the idea that you can't really hire someone to help you fundraise seems kind of silly to me. And broker-dealers, for a seed Series A stage company, broker-dealers are not in that space, right? We talk to broker-dealers, and they don't want to get involved with a deal that's under $25 million in size. So when you're talking about a $2, $3, $10 million deal, broker-dealers are not playing in that space. So it seems to me like there's real opportunity to let founders build and let them plug into finders. And I think as we discuss what the role of a finder is, the prohibition on not being able to negotiate terms, well, that's one of the challenging parts of fundraising. For founders, most of them have only ever dealt with the transactions of their own business. So it's hard for them to know what the value of their business is. In terms of supporting sales materials, I've only ever built pitch decks for Honeycomb Credit. Most of these finders come across pitch decks all the time. They know what goes into a good presentation for a startup. And engaging in due diligence, this kind of, to me, comes back to this notion of the credibility gap. If finders aren't somewhat selective of who they're working with and doing some of their own diligence, then we're kind of back to ground zero. So I'm very excited for this conversation, and I think there's tremendous opportunity to bring finders into the ecosystem in a kind of clear, legally defined way to let founders build and get the assistance they need for this entirely different job of fundraising.
Yeah, so my experience with finders is, I think, very similar to Gary's. This is something that I see a lot, and very often as a practitioner, I'm being asked to sort of, what is the way that we can do this? Because they can't just pay somebody directly transaction-based compensation, but from a company's perspective, they're basically saying, hey, this is somebody that can get me access to investors that want to invest in my type of company, that are appropriate for my type of company. They are reasonably being asked to get something in return for putting in what is a fair amount of work. I think you heard that from Kelly as well. And so we are coming up with ways to try to structure transactions that get compensation to folks in an otherwise regulatory framework that is not clear. So what Gary was talking about, do it flat fee, put it into a fund so you can get a management fee, which really just sort of shifts the issue to the registered investment advisor regulations away from the broker-dealer regulations. But those are real problems. This is a very real issue that I see in my practice. I think this is also something consistently that this committee has heard. You heard, this is sort of like decades. People sort of keep talking about this. So I think it's a real issue that the market would benefit from at least some sort of guidance on, for real.
So since we do have all of the information that was put together by our predecessors on this committee back in 2020, are there things from that proposal that people really liked? Do we think we like this tier 1, tier 2 idea? Or are we thinking maybe it would be better to simplify? Are there thoughts on what was proposed in 2020 that we could build on instead of starting from scratch?
Well, I guess I would agree from what Hester Pierce said, or from her recorded comments, and then everything else we heard. It seems like tier 1 is such a restrictive and narrow category as to be not helpful. I don't know what value it adds. So if it were me, I would be thinking, okay, what should tier 2 look like? And how can we make it so that somebody who is a tier 2 person who can operate under some legal framework without being in the shadows, how can they be genuinely helpful? So to your point about, should they be allowed to help put together sales materials or, stuff like that? And so that might, if it were me, I think I would just focus on what should tier 2 look like. Because this is also about democratization of capital. I mean, investment banks take 6%, right? They're allowed to do that, right? But they won't do a small deal. So what is that?
I think the tier 1 is so restrictive that it's impractical. I've made a lot of introductions in my private sector career as well as in my public sector career. It's very rare that I provide just contact information to someone and say, oh, tell them you know me. There's a reputational risk of doing so. You don't know what's going to go into that communication. You don't know what promises could be claimed. So realistically, I would imagine we would see kind of an uneven enforcement of tier 1. Most folks may play by the rules, but it's so narrow that if they contact both parties later on, it comes up at a dinner, you never know, they're then liable for a very large enforcement penalty. So I would recommend combining tiers 1 and 2 and creating a new category of finder, simplifying this.
Yeah, basically just get rid of the tiers, basically, because that was their proposal. I'm just making sure we're all on the same page.
Marcia, I'd like to simply add that I agree getting rid of tier 1. It's hard to have communications without some sort. Well, it's hard to pass on contacts without communications. It's hard, and I think Kelly said it earlier, and I think Kelly may be for tier 1 a little bit because she said that she likes to reach out to folks, but she wants the ability to look at the deck, make sure all the marketing material is fine. So I got the sense that she was okay with tier 1 without the limitations. I've never gotten a deck, and well, I'm more inclined to tell folks, send me your deck, then we can have a conversation about who I know within my network, as opposed to say, here's some names. You're leveraging your social, your reputational, and your financial capital when you're making those connections. And I will say that, just during our lunch break, I checked my email and had 3 finders reaching out with deals that they want to share. I think one of the risks, Commissioner Person, I think all of us agree, is that we need the finders, but we also need the guardrails. But we can't make it too restrictive that folks don't want to engage. And the last thing I will say, if it's possible, some sort of soft registration process. I think Gary said, I think it was Gary, that when he gets a list, he's got links to everyone, so you can instantly check the credibility of folks before you want to lean in. That would be great if folks are reaching out to me. I've got a centralized database and I say soft registration, nothing that's onerous. This is what I'm doing. These are the areas where I'm focused on.
Erica?
Yeah, thanks. Yeah, very much agreed. I mean, I think, one of the things that we want to do is like facilitate people to be able to make these introductions above board and feel like they're doing it within, the existing regulation. And I would be thinking, as we are looking to make a regulation around areas where we're just making sure that there's a true alignment, between the finders and the investors beyond just, oh, well, if I give them bad deals, they won't come back, right? I think, we can take that as a given and also make sure that there are some layers on top of it. I would particularly think about potentially limiting the amount of commission on a percentage basis that they could charge, because I could very easily see founders, who are in a very desperate situation, who might say, okay, great, I'll give you half of the money. And then, without disclosures or sort of expectation of that, very little money actually ends up going to the success of the company and making sure that the company is well capitalized. And beyond that, I do think it's important that there are disclosures to the investors around how the finder is being compensated. Just as in an investment banking transaction, everyone's aware that they're getting the 6%.
Yeah, I think
And I think that was one of the differentiating, missed check marks on tier one, is that it doesn't require the written disclosure. So, I think that's key if we're going to lump folks together.
I mean, when I think about finders, I'm thinking about just the fact that they are getting compensated for the money that they're raising, like a direct compensation. I mean, we heard a bunch of workarounds that people are using today, the SPVs, the consulting fee. I hear that all the time. And so how can we get it to a point where instead of the workarounds, to your point, Erica, like everybody's on board of knowing? Because like if I'm an angel investor, I don't want to, or any investor, I don't want to be investing in a company that's going to use the money that I'm investing in the company to pay back taxes, to pay off some kind of debt. I also don't want it to go to a finder unless I know upfront that that's what's happening and how much. Right. So I think it's kind of to your point, like you don't go have somebody else, you don't do your taxes yourself, right? You have like, it has to be a little bit more legitimized. So like what can we realistically do to put those guardrails around so that we can say, okay, if you're going to accept compensation, this is what really needs to happen in order for the investor to feel comfortable. Vincent.
No, I was just going to say that I think the disclosure aspect is right. I think I doubt anybody will disagree with that. It's been said by a few people. I think the percentage is interesting. I mean, generally, I've if you're out there, it's happening, and I've seen like 2 to 4% is what I've seen myself. So if you want to say a threshold, you could say no more than 4%. I think is probably right, and I think even. Ross had said that anything above 5 for him was kind of concerning. So just from a standpoint of what's out there, I've seen 2 to 4 over, and that's over a long period of time.
And Vincent, just to really quickly weigh in on that number, and George, you might be more familiar with this. I think that for the smaller deals, what I was seeing when I was a little bit more exposed to that area was that it was around 7%. For the crowdfunding platforms that were doing like $1 million.
I'm talking about venture specifically. I'm talking about VC.
Yeah,
so VC,
right.
It's 2 to 4 is what I've seen, and I think that's pretty. It is what it is. But again, at the same time, people should have a right to negotiate what they negotiate. So I'm all for, it's like you're not trying to get into other people's business of their business and how they do it. But I'm just saying what I've seen. I'm not necessarily saying there should be thresholds on it. I do think that this is something that, again, going back to some kind of first principles of what we've talked about for some time, is if we're trying to democratize the marketplace, which, we have to recognize that the private market is now, it's different than maybe it was 5, 10, definitely 20 years ago. It's very much its own marketplace. And, Commissioner Ujeda, referred to this from a standpoint that if, that marketplace needs to be a very fluid marketplace, both entry and exit. And so if you want to have that capacity, then, I think these are kind of some of the players that help create that kind of ecosystem of fluidity. So I'm very much an advocate for, any way we can kind of take off the shackles. Mind you, we clearly need to have some guardrails, but in many cases, I'm sure people here are more knowledgeable than I, and some guest speakers would tell you, and they alluded to it, there are already guardrails elsewhere. So we don't necessarily need to be duplicative. And when we don't want to add new, kind of burdensome, prohibitions or requirements that, may not be additive. So, I think it's great if we can, allow these kind of new class of to acknowledge and kind of let this new class of, I would say, market players and resources, both to investors and founders, to kind of come out into the light from the shadows, and support that kind of new capital that would flow from that activity. So it's more just saying that I think that, when I read through all the materials in preparation, that's why I think I asked Ross. I think that what's been done in the past was kind of tinkering with certain things. I would recommend we kind of take a fresh look at it and say where the market is today. What would we propose? Again, let's not have any legacy infrastructure there to work with. What would we propose for something like this to really get the best out of it, for everyone? And I know there was like $15 million thresholds and $30 million thresholds. There were a number of deals. For me, I see that so honestly very limiting and very burdensome. So I would say let's just take a fresh look would be my recommendation, and really kind of try to empower these market players instead of inhibit them.
So let's just say 2 to 4%. We can debate that exact percentage later. But then what would the limit be to raise 5 million, 10 million, 25 million? Like,
well, I mean, so when we're talking, again, I'm speaking from a venture standpoint, you see, seed rounds, you're talking, $5, $10 million range, you're seeing Series A's, in some cases $20 to $50 million. So I'm just saying at that early stage, I think, and if we're talking about opening capital to players who would otherwise maybe not have access or difficult access, and clearly, that's probably earlier stage than later stage. But at the same time, I'm sure these, finders could be very helpful even later stages too. And I think, Robert alluded to something in terms of the type of capital raising needs that he's seen out in the marketplace. So, I mean, honestly, I would, I just always, at least on my side, again, understanding that there are other guardrails and other protections in other places. I'm always more to
So instead of putting a dollar amount around it, maybe you say something like the raise that comes from finders can only be a certain % of your raise.
Just kind of a question for the room. I'm curious, for those of you who interact with finders sometimes and have that relationship, when are they usually coming into the mix when you're thinking about it from the company issuer perspective, sort of to build on kind of getting some more information about what Vincent is getting to?
I've seen them come in as late as Series A. I haven't seen any beyond that.
Yeah, I'd say primarily it's the early angel, generally pre-VC, because once you tap into the VC networks, those are pretty robust connections, but there are people that do it for the VCs also.
Yeah, remember, family offices will play into this, so a lot of connections. That's what I'm saying. So
Yeah.
I see, I would say comfortably through Series A. Because you're still tapping into, you're talking about, in some cases, $5 to $10 million checks, if not more.
Yeah.
And that's feeding into, a 20 to 30 to $50 million round up and through Series A.
Yeah, I would agree with that. I'd say again, and the bell curve, it sort of peaks at that sort of angel pre-VC level, but it definitely extends. And frankly, there are folks that can connect you to the highest echelons as well. Mostly you're kind of in the broker-dealer world at that point, but it spans the whole scope.
Dennis and then Erica.
I think Erica was first.
Oh, Erica and then Dennis.
Go ahead, Erica.
Okay, sorry, I was saying you could go ahead, but I'll go. So, one thing that I was just going to mention, and yes, I love that, we're talking a little bit around, what would the typical deal size look like for somebody to use an unregistered finder, right? Like a non-broker dealer finder. I agree. I think it would be generally for transactions that are on the smaller side, particularly rounds of 5 million or less, but maybe, to sort of include a wider range, probably rounds of 10 million or less. And, just on the expectation around fees side of it. So certainly in venture capital, right, to use a finder to raise capital for a venture fund, it's generally a 2% fee, right, which is 1 year of management fees essentially. But in my experience, if we're talking about actual portfolio companies, the fee ends up being a bit higher, right? If somebody helps you raise $1 million, they're probably not going to do all of that work for 20 grand. They're going to want, closer to 5% there. So, sort of two different asset classes simply because, people raising for venture funds know that this is kind of like a fees on fees situation. And we're already, we're basically sharing some of our management fee in the future with them. So just a thought to consider as we're trying to get our minds around like who are the majority of people that would fall into these categories as clients.
Dennis?
So this whole issue on finders is new to me. I'm an institutional guy, and so I've not had a lot of dealings with them. So my question might be a little naive, but why isn't this a broker dealer issue? I mean, I've heard some people say the cost structure is too high, the size is too small, or maybe the margins aren't big enough. But you could size a section of your firm like Major League Baseball. You can have a minor league. And so you could put together a group that maybe the structure will work for this particular product, couldn't you?
To date, the market has not done that. I'm sure we could sort of dig into the reasons and whether or not that's opportunity cost or compliance cost, but I will say the market as it exists right now is the brokers, they just won't go down into that level. My suspicion is because there's too much overhead and the cost is not worth it. But again, to date, it's not happening in the broker-dealer world. I don't know all of the reasons why.
Yeah, I would say generally those broker-dealers are looking like, plus 100 million, essentially, for the deal flow that they're looking for, Dennis. I mean, they're looking at a deal where they're, out in the marketplace trying to raise 100 plus. I mean, I could be wrong, but I think generally that's kind of directionally right.
Jennifer?
Yeah, I was just going to add, Bart, I think what Kelly explained, I don't think that's the paradigm. I think what she's been saying is that there are community organizations that organically function this way, where they serve as intermediaries, and so, they create relationships and are serve as like connectors, and so they probably wouldn't want to go down the broker-dealer regime because it's onerous, and it requires having a huge compliance overhead, and it just probably wouldn't be feasible for that kind of paradigm that at least that she's seeing. And I think from what I'm seeing with a lot of the early stage startups, they would most certainly benefit from having someone or resources that can facilitate connections and networks, and especially accredited investors. They usually don't have access to a whole list of references or investors that can provide significant capital. And so having folks, whether they're in the community or individuals that could potentially provide those connections, would be incredibly resourceful. I don't know that the Tier 1 introduction would be of any value to what some other folks have mentioned. I think it's akin to just having a database of contacts or a LinkedIn introduction. You might as well just start there. But I think there is some value in at least the Tier 2 structure in terms of the type of compensation. One of the things that I've seen with, at least in the private placement world, is folks who are serving as a connector or a finder or accidental finder, how Kelly put it. Sometimes they get equity, and I think that was something that someone mentioned as a potential to consider in terms of compensation structure, looking at equity as an alternative to transaction-based compensation.
I'd be hesitant to put a percentage on it if you have the disclosure. And that's to counter the example where someone would have 50% of the company as a finder fee, because that contract wouldn't execute. If you're looking at a deal and you can see that your finder is getting 50% of whatever that deal is, then it's just not gonna execute, and they're not gonna get it anyway. So if you have, let's say, a 5% cap for this, whether we do tiers or category, they're going to remain reasonable so long as there is a disclosure process in there, because the accredited investors reviewing this will know the red flag of, wow, that's 40% to make this transaction happen. So I don't feel there is a need.
Yeah, I guess I would also add, I agree. I think that limiting the ways in which finders can be compensated does put limitations on how much this would be democratized and used. So I believe that stock should be an option. And again, as was raised earlier, I think by Erica, for a smaller raise, for $500,000 or $1 million, 2 or 4% is not going to cut it. You're not going to get much value from $20,000. So, I agree with Vincent that taking a fresh look at maybe the items in this column and say, how relevant should they be to a Tier 2 finder? Certainly I would agree that Tier 2 finders who are not broker-dealers should not handle customer funds or securities. Probably shouldn't, because they're not a bank. I think there are some clear things where we could all agree, say, yeah, if you're not a registered broker-dealer, you probably shouldn't be doing that. But yeah, I think taking a fresh look at it makes sense.
So along those lines then, what about the marketing materials? That was one of the things I thought was pretty interesting about what Gary said. He's like, hey, if I look at a pitch deck, I'm not going to forward it on if it doesn't look good, right? So at what point then do you become a finder, even if you're not taking compensation? So how do we feel about a finder being part of that? Erica and Dennis, so do you still have your hand up or no? Okay, Erica.
Well, I wanted to finish my.
Sorry. Go ahead,
comment.
Dennis.
So I guess I'm hearing from folks here a little pessimistic about maybe the opportunities at broker-dealers to have their cost structure adjusted to make it more feasible for them to participate in this area.
Yeah, I think we haven't seen that. I mean, I've raised personally amounts of money ranging from $500,000 to $245 million, and I can tell you that the banks I've worked with would never help me raise $500,000 under no circumstances.
Well, what about 5?
No way.
No way? Okay. Thank you.
Erica?
Yeah, so on the marketing materials, right? It's a really good question because, while I agree with you, we can all say, obviously, we want to be able to say to, a company, hey, here are the things you need to provide. Here's sort of the level of professionalism it needs to reflect. As we think about why that might be there in the first place, is perhaps to discourage the idea of finders, producing these materials themselves, and just making sure that there's something in place to be sure that everything that the finder has sent comes with the reps and warranties of the company, right? So to prevent, the possibility that a finder could kind of whip up some things, making statements about the opportunity, about the company that perhaps, the company was not internally generated. They do a transaction, they're kind of now free of it. And then, years later, the investor is saying, hey, you told me XYZ was going to happen, or, that you had this. And, they're like, we didn't even make those. So, I think if I'm trying to think about why it's on the list, it's probably to prevent some of that behavior, which feels like it could be really common if someone's very incentivized to try to get a deal done, is to make changes to make it look appealing as possible, that now the issuer would technically not really have ultimate responsibility for. So I think we can think about that.
Isn't that fraud?
Yes.
So is that not covered?
It is, right? But, I think what I'm pointing to here is that once the transaction has sort of happened, now, instead of the company itself being liable, you've sort of got this independent person, who may or may not be able to make restitution to you. So I think it's creating a little bit of a hole there for that activity to happen. So just something for us to be thoughtful of.
Piggybacking on that, I think another aspect of that Gary mentioned on is also it means that there would be direct communication between the company and the investor, which certainly if we're in the realm of early stage VC, I do think that is something that would cut down on fraud or miscommunication when the issuer has direct communication with the investor. So I think a side benefit of telling the brokers that they're not allowed to manipulate the message is also you're creating that direct one. So I think it's not exactly the same issue, but I think it's related.
But that would still be fraud if they manipulated the terms of the company to make it more enticing for an investor. And I'd like to point out the investor isn't buying it from a tier 1 or tier 2 finder, so you don't have that third-party liability from the example. It wouldn't exist. It would be they come to the table under circumstances which are fraudulent. They would have to be discovered before anything is signed or any money changes hands, because that's contract law. That's UCC. So it really just comes back to fraud, and we're seeing the same fraud protections across all three categories. I don't believe an additional guardrail is needed.
But what about the finder that makes the pitch deck look better, or, not in a fraudulent way, but just to enhance what the company is talking about? Are you saying you think that they should be allowed to do that, or they should not? I'm just trying to clarify.
Is the question whether they should be allowed to make the changes themselves, or to say to the company, hey, you've got two typos?
To say to the company, but that would, either way, it would still make them involved in the marketing materials, right?
I would argue a finder is marketing the company, whether for their benefit or the company's, and it would not be unreasonable for them to say, hey, you have a typo in this, just so you know.
Oh, Erica, sorry. Wendy. I thought you said Erica.
All right, I'm just going to weigh in on this tiny issue. In my world, words matter. So when we're using the word participate, what does that mean? So what Gary described this morning, he read it. He read it for clarity. He read it. He found some typos. To me, that's not participating. To me, that the company prepared it. And I also live in a world of disclaimers. Like, I would expect that the document said this was prepared by the issuer. And so, maybe participate isn't the right word. Maybe there's some other word that we should be using, but his description to me, and I also agree with what Robert said, to some degree, it's not that he's promoting it, but he's also living on his reputation that he's not going to hand over a piece of garbage to somebody who might be interested in investing. So I think the word needs to be played with, but the activity is going to be in a spectrum.
I think that's what you were saying, right, Robert? Yeah. Erica, did you have a comment? No, sorry. And then, okay, so I think we've kind of established that about marketing, but what about in the due diligence process itself?
I'm not the attorney here, but I see, they mentioned the limits on the structure of the transaction, preparation of docs, due diligence, and financing advice. I think a finder will want to do all of those things. They all fit in that marketing and sales bucket from my perspective.
Yeah, and that's exactly right, because I think in most cases, I mean, Gary, I think I think all three referenced it. At the end of the day, for the most part, the way it functions organically is people are connecting you with people that you know. And again, on the reputational basis, I mean, she alluded to it. She's like, you know, if a relationship is burned through a referral, it's not that, you know, some things are going to work out, some things aren't, but getting burned is something else, right? If I make a bad intro, you know, that person's never going to trust me again. So I think for the most part, the way I've seen it's really about people connecting people within their network. I mean, everybody's kind of alluded to that. And, you know, I think at the end of the day, the biggest thing for me is just that disclosure aspect. And I would say everything else, truth be told, I think should be left to whatever is, you know, agreed to between the parties. And if someone has some recommendations for how to enhance a piece of material that's going to help market that company, I mean, I would just kind of let it be, and meaning let the parties decide what they want to decide, and just whatever is agreed to, you know, just disclose it. And as long as that's there, I mean, I think for the most part everything will take care of itself, and then you have these other safeguards and guardrails elsewhere that I don't think we need to kind of try and recreate 3 tiers of the wheel here.
So curious what the other guardrails are. So one thing that I hear that in sort of legal speak, what I hear is no general solicitations, meaning you can only introduce to folks that you know, which sort of prohibits the let's get on late night TV and have an infomercial or, you know, a pump and dump scheme type of stuff. So I think that was one of the messages that we heard, which also dovetails in with our offering exemption, where we're talking about this angel world is largely 506B for sort of our previous one. I think one other aspect of that is somewhat related would be, do we want to limit it only to accredited investors within the network, right? Because that sort of dovetails with this general solicitation, widespread, or within a 506B realm. And then the other guardrails that you're talking about that would provide sort of limitations against fraud or bad actor. What were you thinking of as those limitations?
Well, I mean, the disclosure, I think within the network of people you know, so it's not a general solicitation. I think that's right. You know, I mean, a part of me, because again, a couple of the speakers spoke to it, and I like the idea of having more people be able to participate, right? So accredited, unaccredited. I mean, but at the same time, you know, if the committee was like, you know, we need to have something here, let's keep it to accredited because we're already making an exemption. I mean, I understand that. That's fine. But beyond that, I mean, I don't know what other requirements, what other things would you want to put on it? Because I think this is, for me, the only thing when I see this, like some of the things that we talked through in prior conversations, there's a lot of kind of trying to create a very tight box, and the marketplace doesn't quite function that way, generally speaking. So I'm just saying, outside of like the disclosures within your network, if you want to, you know, the accredited, that's about right.
So kind of going back to what Robert said earlier, so if I'm thinking about all of this, are we talking about like marketing and diligence really is on the onerous, it's the issuer that needs to be the one to give that information. And the finder should not be manipulating, I guess might be a good word, to change any of that or have it be any different, right? And then when it comes to the general solicitation point, I would agree that, no, there shouldn't be general solicitation, but I also think it should go back to whether or not how the company is filing their offering. So if they're a 506B offering, then the finder needs to stay within the parameters of the 506B offering, just like they would with the marketing materials being from the issuer, not from the finder. And then if they happen to be a 506C offering, then general solicitation is allowed, and that would be a different story. So I see the finder being beholden to how the offering is being made. Do people agree with that? Oh, cool. Oh, wait. Okay, so my next question then is, and we touched on it a little bit earlier, but I can see where this would be a very sticky topic, which is about, should the definition of a finder be limited to natural persons? And should it be limited to natural persons in the U.S.? Talk amongst yourselves. No, just kidding.
Would you?
Marcia, while folks are talking amongst themselves as you just directed them, I just got a tangential question. Today was the first time I heard about the Small Business Act of 2025. Does anyone else, was it new to anyone else other than those? It's new to you as well? Does that play a role in anything we're discussing here, or just put that in the parking lot for later? You ever heard, no one's ever heard of it?
I've heard of it. There's always some version of it every year that
Okay.
is trying to deregulate. If it gets passed as law, then it would create a exemption or an open window or eliminate it. So it is relevant to this discussion to the extent it gets passed.
So parking lot.
So parking lot.
Parking lot.
Well, and let me add on too, remember, part of the role of the committee is making recommendations to the Commission and Congress. So when you're thinking about the fact that Congress is considering different pieces of legislation, I think what this committee talks about in regard to finders might be something, that catches their attention as they're moving down. So just to add that into the mix.
I want to go back for a second to the natural person only in the U.S. To the best of my knowledge, the U.S. cannot have regulatory enforcement really materially affect someone in another country where there's no jurisdiction. I mean, you could kind of tether that, but it'd be a very odd process to try to create an enforcement network for such a thing. So
I guess it was more for, what if there was a natural person's, would they have to be a resident in the U.S. or like what if somebody was coming in to the U.S. to operate here and they are not a resident? Anyway, let's start with just natural persons.
Yeah, so I initially brought it up because I was thinking about the backdrop of AI and some of the technology and innovation around autonomous agents and the use of platforms and various types of technologies that might be potentially operating in this space to serve as a connector, facilitator of opportunities in the investor space. And so in light of this proposed exemptive order, we should probably just think about that innovation and how it would impact that definition. I think it's something that is being considered with regard to various other types of regulations pertaining to cryptocurrency and DeFi and considering who is operating some of those platforms, and maybe that's how you would approach it here, right? So if it's an autonomous agent that is acting as a finder, then perhaps we would look at who is the operator, the person. So it just requires a lot of thought process because there is a lot of innovation and technology happening. that we just definitely want to consider when we're talking about natural persons in this day and age. So.
The one thing I would say on that is I don't want a robo-finder. I get enough emails and telephone calls all day, as I'm sure everybody here does, on a variety of things that we don't want. So, and if the idea is a connector connecting you with their network, it's different than, I think something artificial reaching out on a mass basis. But having said that, I want to, you want to utilize technology to help in the process, but I just, I guess the only thing I guess in some way, so it could help create more capital into the capital market, but it just feels a little bit more, it feels a little bit more in the general solicitation framework. It feels a little bit more in the robo-finder framework, and I don't know that was the kind of spirit in which we were talking today about this.
So I think that's a good issue. My suspicion in the initial drafting, and I don't want to speak on behalf of the staff, is that really what they had in the back of their mind was more, is it an individual or an entity? With the distinction being the entity, you wouldn't have the transparency, and for issues like fraud, you could use the limited liability shield of an entity to hide around fraud. So without knowing, my guess is that was more what they were getting at than some of the stuff, the newfangled stuff, which should still be addressed, but may fall more into the
I think that
realm.
the order preceded just the evolution of technology and where we are today. And so I just think that it's something that we would have to continuously explore and understand the technologies that are being developed, especially in the DeFi space, and even off chain. So because there is a lot of innovation happening in this. Anytime you're talking about like marketing, referring, connecting, there's a lot of potential there for whether it's just leveraging AI or what they classify as agentic AI, where there are autonomous agents that have the intelligence and the ability to source through and not just do it on a robo, but a much more effective way. Not an advocate of AI here, but just throwing it out there.
Jennifer, can I put you on the spot a little bit if you can answer? Do you know what some of those technologies might look like? Can you give us a little bit more insight without...
Sure. I can just throw some of the things that I've seen percolating. So I think that there is the ability of technology platforms to develop on-chain and DeFi platforms, AI technologies that can to source opportunities within a platform space that they create. So like a separate world in the DeFi space that allows people to transact and conduct transactions. And so a part of that, I think, is the opportunity to leverage AI agents to act on their behalf. And so one of the questions that has come up with regard to those technologies are these brokers, are these finders? And so because those questions are still percolating, folks are wanting to explore and innovate in that regard, but that there's a lot of uncertainty around that. And so I think it involves conversations that we're having, but also in some of the other areas where it might be more prevalent, especially on-chain.
Sorry.
Okay, one other thing on the natural person thing that actually just occurred to me, and it was based actually on something that Dennis said, why don't investment banks have a little sidearm that does this? My guess is that if we did not limit this to natural person, that if we created a pathway that was much less regulated, investment banks would do this, probably. Yeah, so, and maybe that's fine. Maybe that's fine. Maybe that contributes to democratization.
Mm-hmm.
I just wanted to advance it.
Couple things. What I get out of this is natural person is an actual term that's used and would, this regulation follows. You know, if we're going down artificial intelligence, I think that would not be part of this regulation or could be, you know, could refer to other regulation. But my question for you is, in the circumstances that you're talking about, is there a natural person at the top of the food chain? You know, is there a human who is managing
Yeah.
the AI?
Yeah, and that's what I think it might come down to is the operator, right? And in figuring out who owns the platform. But then it can get complicated even with that because there could be an entity that owns the platform. So, but again, not to overcomplicate the issue, I just wanted to identify it because I do, there are some technologies emerging, especially with soliciting, finders, referring, recruiting, brokering, just, and so, and AI has the ability to do those things, especially autonomously, under the operation of a platform. And so it may not be here now, but it's probably going to come soon.
It's a really important point in 2025, for sure. And this regulation is generally about accountability. So that will need to be explored at some point, but I don't think that should prohibit moving forward with this regulation.
Agree.
And building on Wendy's, and again, I apologize because I'm sure that some of this is my lack of knowledge. So is it even, so thinking about this sort of box they've created with AI, is it even possible to identify the natural person or if it's an entity sitting at the top?
I think it depends how they structure it, but I think, if there is a person that owns the platform, that's the easiest way to identify the owner. But there might be, especially on-chain, a different multi-layered ownership structure because platforms can be owned by communities and DAOs, and it can get complicated there, but there's definitely a way to identify the owner or owners, and that might be a way to get around this. So at the end of the day, it will likely lead to a natural person, which, maybe is consistent with, having this be limited to a natural person that can be identified.
I don't know how you would, if you did a natural person only, that wouldn't prevent this hypothetical AI from doing it. It just wouldn't let you hold them accountable. So that's kind of the difference, because you wouldn't then have a set of enforcement actions associated with it. So if you were to say, a tier 1 finder can only be a human being, you're not stopping a chat bot from making an introduction and getting a commission. You're just saying that's not a tier 1 finder.
So how do you prevent that?
Can you prevent that?
I think the question ultimately becomes who's getting the commission. My suspicion is there's probably a human somewhere getting paid.
And it's probably the platform, so it's probably going to be whoever owns the platform. But that's a great point, because that's what it comes down to. It doesn't mean that the AI agent can't operate. It just means that they would not fit this definition. And so, there's a loophole there, and that folks will go through. So it's just something to consider.
All right, what were some of the other pieces then of, let's take tier 1 out of this. I think we've kind of all determined that. So the first thing that was in the proposal before was about the natural person, transaction-based compensation. I think we talked a little bit about accredited investor, but I think we were basically saying if it's an offering by the company that has to be like a 506B, for example, and they have to be accredited, then that would be the case, right? But Is there any instance where we would think that non-accredited investors could be approached by finders? The way that broker-dealer, or, yeah, registered brokers can? Go ahead.
I mean, it's interesting to think about, if we're talking about they could use whichever exemption and they just have to follow the rules of that exemption, I don't see why regulation crowdfunding would be off the table. I don't know if there's a scenario where the economics do make sense in regulation crowdfunding, but if they're following all the rules of Reg CF, it would seem to me they could also apply there.
Okay. So then you're saying you just don't know if it would make sense from the standpoint of they'd be paying the finder and then they'd be paying the platform in your
Correct,
view.
right, yeah.
Yeah, and I think that then dovetail back to the general solicitation question. So if the underlying exemption allows for general solicitations, do we want to allow brokers to do general solicitations?
Finders.
Finders, sorry.
Yeah.
Not brokers to do general solicitation. Or do we think that is a significant guardrail for the finders that we wouldn't want to encourage them to venture into general solicitation land?
My own gut is that if it's a finder, probably shouldn't be doing general solicitation. It's like instinctually I feel that way because then there's something else. If they're doing that, then they're probably something else.
That's where my gut is as well, but I think it's part of the discussion in terms of the parameters, and I think that's part of the discussion. So.
I was going to say, that's an interesting question. What if they are not receiving compensation? Because like in Kelly's instance, she was talking about how some of the connections and some of the relationships that she's connected her entrepreneurs with, she's done it, she hasn't received any compensation at all. And then she did mention that there was that class of potential capital out there where they're not necessarily, they don't fit that category of accredited status, but they might have the ability, or they may be invested in the specific venture or the unique business proposition. And so there was all that opportunity that, that doesn't fall neatly under the accredited status. And there might be a way to allow organizations that don't receive any kind of transaction-based compensation, but are really doing this kind of work just because that's what they do as part of being community builders and connectors in the community, and accelerators, folks that like to connect folks with people that can potentially help with their entrepreneurial needs. I think that might be one of the ways where it could be something to look at, where we allow general solicitation for organizations that aren't really for profit, but maybe they're in this space just to facilitate connections and relationships.
If you don't receive compensation, are you still a finder?
That is an excellent question.
Maybe you're just a friend.
Well, so
Right,
and
right?
the SEC can correct me on this. I believe in the marketplace, it is generally viewed that if you are not getting transaction-based compensation, that you would not be considered a finder or a broker. To my knowledge, there has not been definitive guidance on that point. Maybe somebody else knows of some. So I think it is a generally accepted position, but I can't point to the statute that says that definitively.
That's a good point, though. Erica.
Yeah, absolutely, Bart. So yes, I what we're kind of discussing today is this idea of allowing a certain category of people who would be wanting commission-based compensation to perhaps be able to operate under some exemptions. If you are not taking any sort of commission or transaction fee, or you're one of these local groups, you're free to organize, and make introductions. You're now not under this specific regulation that a broker dealer would be under. So those folks can already do this level of introductions, whether or not they're allowed to somehow participate in facilitating a general solicitation. The company would be also responsible for making sure that they're operating under regulations that permit general solicitation, like period. I think what's important, I feel like we're exploring a lot of different topics today, but I also think it's really important for us to, sort of focus into the specific issue at hand around, folks who would like to be able to take a commission, are currently unable to, and the fact that broker dealers generally will not service clients that are doing fundraisers of, say, less than $20 to $30 million, or probably 20. How do we fill in that gap economically?
Yeah, and I think, so far we've talked about a lot of the things that were listed in the proposal from 2020. The one thing that we really haven't touched on yet is how do we think that this would need to be disclosed? Like what is so if we're saying that, so far what I've gotten from this, you guys can correct me if I'm wrong, that as long as the company is, and the finder is abiding by the offering of the company. So again, 506B, they have to do all the things. 506C, they'd then be allowed to do more things. The marketing material, the diligence is being issued directly from the company, that the finder is not creating their own, essentially. So I think we've talked quite a bit about that. If there's anybody that does not agree with what I just said, please speak. But I think the real thing then, to your point, Erica, is like, how do we then say it's okay for somebody to take compensation, transaction-based compensation for these introductions? And in my opinion, part of what we heard today is that we really need to know through a disclosure of some sort what is going on. I know I, as an investor, would want to know if there's a finder involved that I'm not even a part of, but I'm an investor in that company. So I think there's disclosures on both sides. The finders have to be able to disclose, but then I think the people who are also a part of the company has to be on the up and up too about what's going on. But would love to hear thoughts on that.
I think what Gary Ross recommended was having something within the Form D, which seems to make a lot of sense to me. I think that helps reduce some of the asymmetric information here, right? Like to build a trusted marketplace of finders, to be able to look someone up and see what deals they were associated with and the outcomes of those deals. That's how you build trust in a market. So, and that's a Form D is getting filed for every one of these raises. So it seems like a relatively easy place to insert this.
I have a question, if I may. How scrupulous are issuers at filing Form Ds? Do they all file Form Ds when they're supposed to?
No, they do not. We have a lot of clients that come to us. They've had prior raises or whatever, and they don't have Form Ds on file. As a law firm, if a client comes to us, we're filing a Form D for them, but a lot of issuers do not. So that's one reason why I think it's a good thought from Gary, but I don't think in practice we're going to have full information or the information that we think we should have. I think this is just a thought, and I think Herbert had mentioned it, but some sort of soft registration or something that these finders could put on file with the SEC that allows the SEC to scrutinize or regulate or somehow keep oversight on these finders might be a protection for the investors, but also helps create some level of trust or certainty among this finders. Because as it would stand, we wouldn't have any information on the finders aside from maybe a link in the Form D. So maybe if it's centralized and the SEC is actually keeping a database, they have to have certain credentials or something else that qualifies them. It might add a level of trust to who these finders are, because I think the underlying fear is these unscrupulous actors, these wolves of Wall Street that are going to call, and to help avoid that, maybe having an extra step of registration. I don't know how much a burden that is or what that would look like, but maybe it would help limit or curtail some of the potential downsides.
Yeah, I wouldn't recommend that. I would say, again, from the way I'm thinking about it, these finders are going into their own network. So when you talk about building trust, that trust is pre-existing within their own network. So it's not as if you're trying to build market trust in this person and the market is unaware of this person. This person's kind of marketplace of relationships that they're leveraging for the given startup is their own given network of people that they know and have done in the past with. That's more applicable if it's somehow general solicitation in my mindset versus within your own network. But
The one caveat I would put on that is you need visibility from the issuer side as well, which may not have that's where the blind spot may be, not on within the.
Robert, then Erica, then Wendy, and then Laura.
All right. So just going back for a second, if we do make them register in advance of a transaction or credential, would you not then just be creating 2 tiers of registered brokers, which in my mind is separate and distinct from the example proposed earlier, which was a record of transactions in the past, soft registration following a transaction, which, if I understand correctly, Gary's point was someone says, oh, I've done a dozen of these, and you can look them up and you can say, I see no other transactions under this person. So that wouldn't be a hurdle in advance. It would be accountability and oversight following success as a finder.
Erica. Oh, you're on mute.
I pressed hand lower instead of unmute. So, to me, the one thing that I think would be critical is that the finders, disclose to the investors in writing, preferably very early in the communication, that they are working on behalf of the issuer and that they are being compensated in XYZ manner by the issuer. To me, I think that's somewhat important, so that, folks just know from the very beginning that I'm a representative of the company and technically working for them. I am not your agent, and just to really have that clarity.
Okay, so I'm struggling with what's already in regulation and what is being proposed for regulation, but I will figure that out. The question that I had for both of you is, isn't this Form D already required?
Yeah.
Yes.
Okay.
It's required, yes, but it's not always filed. It's not, there's
Right,
not.
so I didn't know what we were proposing since it's already required. That's where my struggle is. It's already required. Are we looking for greater enforcement? Or are we looking for Kelly's suggestion is there needs to be more education so people understand what the requirements are, what a finder is, some of the things that we're talking
So
about.
the Form D is going to be filed for any exempt security. So it's going to have all the information about the raise, not just with respect to the finder. So the finder is just one line item in this Form D. And a lot of times that's just going to be blank right now because there is no legal framework for finders. So a lot of times, unless there's a registered broker, which is going to be rare again because of the deal sizes we're talking about in a Form D and things like that. So what we're talking about, we're just not going to see a lot of that finder line will just be blank.
And reject the form, but that.
Well, and right now it's just the commission amount, so it wouldn't have the identity of the finder. Okay, so that's the slight difference. And then under the existing regulatory framework, there are no finders with any Reg D deal, so that nobody ever pays a commission because that would be illegal broker-dealer activity.
No, the only thing I was going to emphasize is that, and I agree with Erica here, I think that for finders, having a suitable list of items that they disclose to investors early in the process, and also, a list of either disclosures or whatever to the people who are employing them, to the sponsors. I think if you have that in place, then you can create this tier of, this single tier of finders that, so long as they're, operating in good faith and with suitable disclosures, I think it's, I think you could do that without creating a tremendous amount of burden, and make it very clear and bring people into the light.
My only point on that would be I am 100% in favor of making sure that finder fees are disclosed to issuers. I would say as an entrepreneur, before I would agree to work with a finder, I would make them prove to me that they could actually get me introductions before I'm signing a contract with them. And so I don't want to be overly prescriptive on saying, oh, you must be in contract with a finder before they can actually do any work with you. Just thinking about how the market might settle itself.
Yeah, that was I was a little bit confused on that too with the Reg D, because wouldn't they file that at the time of the offering? And what if they started working with a finder later?
Are you talking about the Form D?
Oh, sorry, Form D.
Oh, yeah, so Form D, you would file it after your first capital commitment.
Oh, got it. 15 days after. 15 days, right. All right, so then back to disclosure. If I'm hearing what we're talking about, we're basically saying that we would want the finder to disclose to the potential investor that they're a finder, that they're working with the company, and that they are getting paid, getting a transaction-based compensation for working with the company, right? But George, to your point, you're saying that you would want to know the history of the finder, or if they're able to find what they're findering?
I think the implication was that we would require someone up front before the intro happened to disclose it to an issuer or to a funder. I would say that maybe it happens later in the process, because I don't know, the finder and the entrepreneur and the issuer might not be in contract before some of those introductions happen.
Oh, I see, okay. But what about introduction-wise, but what about before funds are
Right,
transferred?
before
Okay, yeah.
money moves.
Before
from
money
point-
moves, is what I'm trying to say, okay. Other pieces of the disclosure? We just lost half our team here. That's okay. We're about out of time for today anyway. So let me just see if I can wrap this up, and everybody can tell me if I'm on the right track, right? So we like the idea of having an exemption for finders, as long as they are beholden to the offering of the company and they abide by the rules of the offering of the company. That includes marketing materials, diligence, general solicitation if or not allowed, and we would want said finder to disclose before any money changes hands that they are getting a transaction-based compensation for bringing the parties together. Did I get that right? Okay. My job here is done. No, I'm just kidding. Okay, so is there anything else that we missed here? The one thing that, with the written disclosure to investors being required, we would then say that was something, so we would basically, if we're looking at what was proposed in 2020, and I'm just using this as a guide, because they did obviously talk a lot about this too, we would just take away the tier 1 idea and say this is finder's exemption, right? And the time that we would have the written disclosure to investors would be before there was any closing within the offering. All right. Well, then shall we say that we're going to continue this conversation in November and maybe even come back with some type of recommendation? But in the meantime, until our November 4th meeting, which hopefully we'll be back in this room together, we mull this over, think about it, and then we can come back together with a little bit of structure around that. If in the meantime people end up talking to others, we can bring that up at the next meeting and have a little bit more discussion. Everybody okay with all that? All right,
Can we
excellent.
get an electronic version of this so that we can mark up this last page?
You have it.
Do we have it?
Yeah.
That's right. It's part of
Okay.
the preparatory materials. You
Got
have
it.
a copy
Sorry, I
of
missed
the,
it.
yep, all of it. Sorry.
Excellent. And I would like to just say thank you so much to Courtney and Stacy for helping to facilitate today. Everything that we saw today was definitely helped through their office. We got to hear some amazing speakers. They were extremely informative. And I would also like to thank the committee for your participation. And we will see you on November 4th. And so now I move to adjourn the meeting.